Hey, good afternoon, everyone. Marty Missouri here, July 27th, 2022, with your midweek stock market snapshot. Just a heads up, this should be my last post for the week. In fact, I suppose it is, unless you get something super early in the morning for me tomorrow. I'm going to take a couple of days off and go backpacking with my youngest son. Looking forward to it. The economic update will come to you late this weekend, and it may be just a rundown on the score of our economic index on the written blog as opposed to a full-blown video as usual, but could be a video. We'll see, time permitting, this weekend. Now, please forgive the noise if you can pick that up. It's Wednesday afternoon and I've got yard people right outside my office window here, just in case you get that feedback and wonder what that is. So, phenomenal day today to the upside. S&P was up just over 2.5% on the day. There's nothing but good things to say about a day like today. It was pretty good breadth. It wasn't for most of the morning, but by the time Chairman Powell was done with his press conference, most sectors were up. Treasury bonds were off a little bit, which probably makes some sense. So today I'm going to show you this first screen here, which is the latest commitment of traders among S&P 500 futures, non-commercial or speculator traders. And then we're going to get to the normal charts that we look at. But I wanted to talk just at you for a minute about today's press conference. I actually watched this one start to finish. I was really wanting to get some signals from Chairman Powell in terms of what he's really up to or what he's really thinking with regard to markets, because you get a lot of commentary from some pretty smart, experienced veteran pundits who essentially say that a rising stock market is essentially a contributor to easing financial conditions, not tightening financial conditions, which is what the Fed is trying to do, is tighten conditions and bring down inflation. And therefore, the Fed is not obsessed with the stock market like it has been in the past and is willing to sacrifice it to handle inflation. Now, on the written blog this week, I suggested that I don't quite agree with that when you look at how they continue to signal to the market when they're about to do something they think might upset that apple cart. Today, he was served up on a number of occasions, one in particular, questions that would really commit him one way or the other in terms of his or the committee's, speaking on behalf of the committee, sentiment toward the level of the stock market. The question that was really served up that would have strongly clued what he is thinking was, if you had to make a policy mistake right here, would you prefer it be in the direction of too high interest rates, too much tightening, or not enough? Now, if he said too much tightening, the market would have rolled over hard and we'd be down 1 or 2% today, I would suspect. And he became very uncomfortable with that question, because the obvious answer, if indeed they're going to go hard on inflation, would have been, right now, under the circumstances, with the pain people are feeling with this inflation, if we're going to make a mistake, it needs to be in the direction of tightening. Oh no, he did not go there at all, and he essentially didn't really answer the question. And by not answering it, he basically confirmed what the bulls are thinking, not the pundits who I just referenced, that they are very much there to support the market at some level. I would maintain that the Fed put, so to speak, is very much in force. I've maintained that from the get-go. But I don't believe they would step in and just halt monetary tightening just because the market drops another 10 or 20% from here. Maybe 20. At some level below here, yeah, I do think they would claim victory on inflation because of the stock market deflating and sending everybody inside, perhaps, or anticipating that, to where they would really slow down on the monetary tightening. And he even suggested that, he hopes not to have to be this aggressive going forward. So he really served up another one once again for the market. So nothing but bullish short term. Now, this would be like the fourth Fed meeting in a row. Nick did an analysis this morning. I don't recall, but I think it's the fourth in a row where we've had a big, 2+% move, maybe 1 to 3% move on Fed day. Each one of those days, I believe, without exception, but again, I haven't looked myself, the market gave a lot of that, if not all of it, back the next day. I don't know that that's what's going to happen tomorrow, but I want to address that, and I want to talk about other under the surface structural things that I like to look at. For one is the screen in front of you, which again is the net positioning on future speculators. So this means that speculators in S&P futures contracts are net short. When you square them up, they are notably pessimistic, or they were last Tuesday, which is when these numbers are recorded. They're given to us on Fridays, which takes us back to, the throes of the bear market in 2020, or just coming out of that. So recall, folks, that when you're short, in this case, you have sold futures contracts, borrowed and sold them, and you don't get to leave town until you've replaced the contracts, bought them back, and replaced them. So if they're selling futures contracts at some elevated level relative to where they ultimately expect to buy them back at a lower level, replace them and pocket the spread, pocket the big difference, meaning you sold, you collected money here, you bought a lot cheaper, you gave the lender back what you borrowed, and you get to keep the cash in the middle. So that's short selling, and you do that when you think something bad's going to happen. Now, the bad thing that can happen is to you if the security that you're short actually goes up in value. Because remember, you have to give it back. So in this scenario, you paid this, the thing starts ramping up, and it takes off without you, and you know that you have to ultimately buy it back and again replace it or give it back to the lender, and the difference between the two, the spread, is what you now lose. So as it looks like the market, in this case S&P futures, are going against you and it's building momentum, you close or cover those shorts. What do you think happens in a market that's ramping higher when all these folks bail on their short positions? That just adds fuel to the fire, and that's that term short covering rally that I've talked about umpteen times over the last 20 years to all of you long-term clients. The other thing has to do with a more recent topic that we've begun to really study and really get comfortable with, and that is positioning among options dealers. There's a lot of options volume out there like we've never seen before since COVID. The market today is, in some respects, like the tail wagging the dog. At times, it seems like the options are driving the stock price, that the stock is a derivative of the derivative as opposed to the stock price driving the options. So, case in point, we've retained a firm that just does nothing but study options positioning, and they feed us information twice a day, and then lots of data, lots of indicators that they put together as well. So their note today was that you've got that 4,000 level on the S&P, which is really stiff resistance for the moment, right? And then, they pointed like 3,900 or so as the first level of support. Like I said to you, I think in the last couple of videos, that if we break through that, this options positioning could flip in a hurry, and they made that point this morning. They said if we do get the kind of information that would send this thing with momentum through 4,000, good chance we're going to see a lot of call buying up in here, and therefore the dealers who sell those calls have then got to hedge their exposure, because they lose money when the market keeps going up, by buying the underlying. That's called delta hedging when they first issue it. And then as the market moves against them, there's a term called gamma hedging, which we can get into at another time in terms of definition. And that just exacerbates it as well. So you had the short covering today, and you probably had this action going on as well. And then another thing, while I'm on the topic of options, there's been so much options activity under the surface. It's firms like us hedging with put options and so forth. So much so that it's depressed volatility and actually provided some support for the market. As optimism picks up and it looks like maybe there's momentum and maybe they don't need to be hedging like this or speculating like this, and they essentially begin giving up on those positions. Suddenly, that support underneath the market from all that defensive action goes away and complacency sets in. And then suddenly, unfortunate inflation data, poor earnings, lower than what was anticipated, and so forth. And then people start looking back at those levels and say, oh no, we're going to get there, and then start selling into that. Suddenly there's not that support lying in wait underneath to provide somewhat of a floor into the market. Instead, these people scramble to reestablish those hedges, reestablish those short positions and the speculative put positions, and that exacerbates the downside. And that is consistent perhaps with some of the past bear markets. I'm going to show you some charting of movement in past bear markets as well today. So I don't want to discount the fact that, perhaps the bear market is seeing the worst of what it's going to see. That's not our base case currently, although as I've expressed with some of the data and some of the consumer, the strength of the consumer, underlying liquidity, we're open to the notion that maybe the whole bullwhip effect, which I gave you some real detail on in terms of the concept, won't be as bad in the aftermath as so many really smart people are suggesting. And I wrote a whole piece on that, and send me an email if you don't have a link to that, and I'll send it to you. That suggests that maybe we should be looking at this a little more in a little more balanced way, and consider the fact that maybe it's not going to be as bad as we may have previously thought. Having said that, we still think there's a really good chance that this bear market hasn't seen the lows, and what we've experienced so far is kind of your classic, and you'll see what I mean by classic in a minute, bear market rally. Okay, so let's jump to the charts, and just since I have the daily one up, we'll go ahead and start with that one. So recall, folks, that I was skeptical. As we came out of this, I said, there's reasons to be bullish, but I'm skeptical about earnings and so on and so forth. Then we broke through the 50-day moving average, and I said that was bullish. We talked about that right here. I said, now if we break down below that, it's a failed breakout, and that can get really, really ugly. And I had a trend line drawn down to here at that time. So we had busted through the trend, busted through the 50-day moving average, tested it yesterday, finished right up on it. And technically, this was a pretty impressive day today. And this is your next trend line. You can notice we start here. We have this legitimate point, 1, 2, and then 3 falling off of that today. So just, poking its head above that and then falling back below and closing just below that is interesting. Tomorrow, if the day after the Fed runs true to form compared to other Fed days of late, well then we're gonna look like we found pretty stiff resistance right there. It wouldn't surprise me though to see the market catch some steam. Wouldn't surprise me either way, quite frankly, folks. But in the longer term scheme of things, to what degree should we be thinking or be hopeful that this is the worst is over, right? So notice right here in preparing for this video, I drew this this range right here. Let's just call it 19.92. Let's just call it right here where the bear market became official. It might have been right here, right? So here is where we bounced pretty hard. In fact, I could bring it down to here, and there it's official. And ironically, remember, folks, right there is where we got really, really bullish and said bear market rally is coming. And it was literally right there where it happened. I had a circle drawn on that on the 60-minute chart. And then, but I was actually pointing to like 4,300 as my highest upside target to get to when we were having this conversation here. We didn't make it. We started to try to consolidate right there, and then we fell apart and we gapped down to here, and we found support right down right here at just above 3,600. A lot of people now are saying that's the bottom. We're not saying that at this point. Then recall right here I pointed these gaps. I said, folks, look for these gaps to get filled. They typically do. And so, within a few days, sure enough, we filled that gap and then fell right off of it. Boom, boom, boom. It became resistance, which it tends to. And then I said we would fill this one, but we fell right off of that 4,000 resistance. And today we closed above it with a little bit of momentum up into the close. So today, where do we close? Literally right, almost, maybe just above the top of that gap, almost right on it. Okay, so that's interesting from a short-term trading perspective. Swing traders might be gaming this right now. But what I wanted to point to is this. This is the 200-day moving average. And I wanted to show you that bear markets past, right, once they become official, you tend to see at least a test or two or three of the 200-day moving average. Okay, so suddenly that 200-day moving average, if we are ultimately going to test that, this continues to slope, it's going to be right around that original 4,300 mark that I was talking about as the top end of our bear market rally. According to our friends, the options experts, they say that if we were to break through there and you were to get all that hedging, gamma hedging I talked about a minute ago, 4,100 would be the next, as they call it, call wall to look out for as resistance. And we closed today at 4,023. So now when I go back, and let's just look at the tech bubble experience. So I'm just going to go 1995 to 2005. It's almost the same spot right here, 19.24, a little below that, call it 20%, so just about a bear market right there. And we got a bear market rally, a lot closer to the 200-day moving average than we've gotten so far, not quite a test. And then we fell down off of that huge bear market rally, came through just like we're doing right now, came through that 50-day moving average, tested it, succeeded, came up and died just below the 200-day moving average. Fell back down again, came back, boom, boom, boom. While we were in, recessionary bear market conditions, the market just couldn't get through there until its work was done in essentially March of 2003, before we were off to the races to top out when the real estate bubble finally popped. I was doing some work here for somebody in the past looking at what happened to the market during different regimes. So that's why that's still left in there. And then 2007 to say 2010, we'll cover the next bear market. Boom, 20%. People are feeling horrible. Look at that. Breaking through the 50, testing the 50, succeeding the test. I bet a lot of people thought ball game over, and then died right at that 200-day moving average. And then the 50 became the line of resistance until it broke through there, wrestled with the 200-day moving average into the summer of 2009 before it kind of left it for good. And then we had corrections along the way and so forth. So my point is, folks, you can expect under most protracted, prolonged bear markets that tend to come during recessions, tests 1, 2, or more of the 200-day moving average. And my point today is that we've yet to even do that with this one. I'm not saying that it's not over. I'd love for it to be. I'm just saying we have to be smart and thoughtful and look at historical analogs and take everything into consideration before we back up the truck as if the worst is actually over. Looking at our momentum indicators, still constructive, and even more so here on the daily, right? This is a lower high on the price chart, but this is a higher high on the MACD, and that's a higher high right there on the RSI. So that's bullish. And then with the 60-minute chart, remember we had this rising wedge here, and we broke out below that, but not to any great degree, but we did have these bearish divergences. So we really still have a rising wedge pattern. So that's still intact, and frankly, on the 60-minute, these divergences are still intact. So unlike the daily chart, the very short-term chart says, don't go throwing a party yet. We still need to break. We need to break out of this with momentum, and these divergences need to go away. Meaning these momentum indicators need to validate the move in the price chart, which they're not at this juncture. Okay, so real quickly, we'll look at the weekly and the monthly, and I'll let you go. So on the 3-year weekly chart, we do now have a legitimate buy signal, albeit barely. You can see that white line just peeking its head above the red line. So that's a buy signal on the MACD. We flagged this here a week or two ago. Bullish divergence down here on the RSI. So that was positive. Now, what we want to do, though, is we want to do the same thing, right? Let's just go back to that 1995 to 2005 period that we looked at a minute ago on the daily chart. And what you're going to see on the weekly, right, is you're going to see buy signal, right, boom, but then failed. Buy signal, boom, and then failed. Buy signal, boom, ultimately failed, and then a buy signal that took. Okay, so if I ran that on the 2008, you'd see it again. You'd see multiple MACD buy signals. So again, I like it. Suggests that that rally, or confirms that the rally we just had, but nothing about the history of that signal amid bear markets that says that we should feel real good about our prospects going forward. And then on the monthly, I'll just run the 30-year chart. In my view, this is the most compelling of this long-term signals, and that's this monthly MACD. The monthly moves are, of course, slow moving. And so when we get that sell signal and we get it and it really rolls over, bad things tend to happen. Sell signal, you know, this is 50% decline, almost a 60% decline. 2011, 19.9% decline, 16% decline, 19.9% decline, 35% decline, and this is probably the most ominous sell signal so far with your negative divergences. And folks, there's nothing happening here on that long-term chart that says we should remotely be thinking that we're out of the woods yet. Now, we may be. Of course, it's going to show up on the weekly before it does on the monthly. But if you wanted to play it safe, you would wait for some really good confirmation here, you know, on this monthly chart. And as for the trend, this downtrend is still very much intact. And our level would be that 50-month moving average if we're outside of recession. And so if we just have kind of your mild recession or non-recessionary bear markets, you know, we've had a nice bounce here. We're still not making it above our trend line that we drew here. And we've got about 13% left to the downside now after this big pop. So bottom line, folks, there's just a lot left to do here for this market. A lot of technical damage that is a long ways from being repaired. We have a Fed who is not accommodative by what people think are accommodative standards, which would be printing money and dropping interest rates. We have a Fed that says they're very concerned about inflation and is going to do what it takes to get us to 2%. Just to give you a feel for our view of today's move, I listened to a person on Bloomberg say there was nothing dovish about it. I beg to differ. Here was my note to Nick. This is as it was going on. It reverts back to that comment I made earlier. Powell was served the perfect question to gauge whether he cares about the stock market. If you had to make a mistake, would you prefer it to be to the upside in terms of tightening or to the downside? He painfully dodged the question. The upside answer would have utterly tanked stocks in that minute, and he knew it. By not answering, stocks jumped in response. Even though the market rallied into this meeting, I was kind of thinking that with the market rallying into this, he could afford to be a little more hawkish. But basically, I said he's a slave to the market. Nevertheless, a lot of pressure on him to get this inflation under control. The thing is, all they can really do is hammer asset prices, which could, in a reflexive way, could actually do a number on inflation, and hammer the demand side, right? Make money expensive enough that people stop spending it, right? The supply side issues, which are huge and in some respects are structural and long-term, they really can't do much about that. They can't print oil wells, right? They can't print supply chains. They can't print friendly global relationships, right? They can print money. They can stop printing money. They can raise interest rates. They can kill demand. Tough job. Wouldn't want to be them. Wish them all the luck in the world. And like I said in yesterday's blog post, nothing would make me happier than to be reading some future magazine cover that says that Jay Powell was the big winner and saved the world, or however you want to say that. Folks, thank you as always for watching and listening. Again, nothing from me the next couple of days. Late this weekend, probably Sunday evening, something with regard to our economic update. Take care. Have a wonderful weekend. Bye-bye.